I do think that the dollar is going to weaken. This is going to be a long-term move, I think, in the currency. Now, what we have to understand is that the dollar is going to weaken from extremely expensive levels. So in many of the real effective exchange rate models, which is the way that many people value the dollar against other global currencies, it's as much as 20% overvalued relative to other currencies. So what happened really since 2010, there was a significant surge of inflows into U.S. assets. U.S. exceptionalism, as people call it. We had equity prices going up. U.S. equities outperformed the rest of the world. That created a lot of dollar inflows. Now, as things start to move a little bit more sideways, there's repatriation out of the U.S. and into local currency. Now, remember, a weaker dollar is actually stimulative for the rest of the world because many people have their debt based in dollars. Cheaper dollars make it easy to repay that debt, and it also helps with the trade balance in the U.S. So it's almost like a win-win. But what we have to remember is that the dollar is softening from very expensive levels. It's not devaluing to very cheap levels.
So a stimulatory effect, no doubt that's welcome given all the volatility we're seeing and some of the trade tensions. But what about the end game from here? Because there's been a lot in the narrative overnight from Scott Bessent, and some of that suggested any budging on the current trade situation would just be welcome rather than this end game of bringing entirely manufacturing back to the United States, which makes us think, well, where are we at in this negotiation phase, and what exactly does the Trump administration want to achieve here? Which goes to the heart of volatility. Do we take it all seriously because we're going to become a 100% almost manufacturing hub in the US with everything more expensive versus some sort of halfway house where we just get better trade terms for the US?
Right. So I think what is the U.S. trying to achieve, I think, is the question, right? It's not been very, very clear, and I think this is one of the issues. But I think from the administration's perspective, their view is that it has been clear, and maybe not to the rest of us, but to them at least. They need to communicate this better. I think part of this is about goods, and certainly that trade component. I think that's actually 1/3 of it. I think the other third is about the non-tariff barriers, right, to try to figure out regulations, how to get U.S. exports into the rest of the world. And the other 1/3 is really about China policy. So I think that when we start to think about tariff rates and policy rates, I saw you had a previous guest on from Fiji. I think all of this stuff is very, very important, but what we need to focus on is the bigger picture. So I think that when we think of how the U.S. administration is approaching this, I think it's more or less in all of those three cases. And I think that the markets tend to focus this on just goods and what rate and what tariff rate with what country. I think that's a way to do it, but I think it's missing the bigger picture.